Joining us now for more on the markets is Joe Duran, who's the head of Goldman Sachs Personal Financial Management. Joe, thanks so much for taking the time here on the day. Help us make sense of this move higher today.
Well, I think we're recovering. We all know that we've been told this is going to be the worst week for the health front. But I think what we're seeing is that things are starting to level out. And while there will be awful human consequences, the fact that we can kind of start imagining getting back to work at some point, that the death toll is stopping or at least halting the growth rate that we were seeing is very encouraging. So there are three things. That's one. Number two, it is not trivial that we're talking about resolving the energy uh, uh, situation that's happening right now with oil prices and the fact that they've stabilized some, even though today they were down a little. I think the fact that it's being talked about is helpful. And third, a lot of what we had, which was a pretty significant liquidity pressure, especially in fixed income, a week, 10 to 10 days ago, that's settled out as well. So I think people are starting to get a bit more constructive. It's a warning sign that when we have these incredibly elevated levels of volatility, you don't want to be making sharp moves in or out because, as you can see, the markets are very, very reactive, both up and down. And so it's very easy to have a completely different feeling one day to the next.
And so, as we're continuing to track this, we have been watching all of the banks come out with their own predictions of where GDP could drop to. Janet Yellen also saying today that she sees Q2 GDP dropping as much as 30%, unemployment dropping to 12 to 13%, are already there, with the peak of both the economic and health damage still to be reached. Is it too early to believe that the market has bottomed?
Yeah, it's probably too early. I think it's quite possible that we've seen the lows, but we should not assume that it's the end. We are going to have some economic hardship. The recovery is not going to be straight back to where we were prior to the virus. The damage is just too deep for that.
Yellow.
And we also don't know what comeback looks like. So I think what you've got to expect is that it's going to be messy. Bottoms, by their nature, tend to be fairly messy. And so what we would suggest to everyone is make sure you make no extreme moves. Make sure that your allocation reflects your current risk appetite. And take into account the fact that we have experienced already a bear market. It has already priced in a recession. That doesn't mean we automatically go into a bull market. More likely, we're going to spend the next 3 months or so settling out, having very strong up days, having some scary down days as well. But don't do anything extreme. We already peak to trough had a 34% decline. That's more than the average decline. Typically, if you look back to 1945, most declines in excess of 20%. The average decline is actually minus 29. When we peak to trough, we're down 35. And actually, if you take an equal weighted S&P 500, we're down 40% peak to trough. That's already pricing in a very, very extreme recession. You see that in small caps. You see it in the equal weighted S&P 500. So we've already had it. We've already had a very good recovery. We might go back and test it. I will personally be surprised if we go much lower than that, because that's reflecting already a very severe recession. And again, I think you might see the recovery be quite significant. At Goldman Sachs, we predicted a 30 to 34% slowdown in GDP this quarter coming up. And then a very steep recovery, again, unlikely to get back to the old peaks, but still strong enough that it will be a very big rehiring, a very good recovery that, again, will not be a straight line, but will put us on a good footing. And remember, we have very good valuations going into this.
And so when you're looking at the different areas that consumers are still comfortable engaging with right now, either out of necessity or out of interest, what are the sectors that you look towards to really kind of stimulate some of that recovery effort on a broader scale? And what does that look like to you?
Well, for our clients, first and foremost, the most important decision you can make is what's your overall beta? What's your overall asset allocation? Are you allocated with enough in stock and relative to bonds? If you went into this decline and hadn't rebalanced, you're probably, if you're at 50-50 and we experienced a 30% decline, your portfolio is now 65-35. So you're wildly underweight to equities, even though your risk profile might still be 50-50. And so one of the things we're telling people is you start by rebalancing, making sure that your equity to fixed income mix reflects your ability. Number two, don't try to time this market. You will have, if you try to pick a bottom or pick a top, you're going to lose it, because not only do you have to be right about whether you should be in or out, but you then need to be on the other side of the trade as well, which is almost impossible. So just make sure, again, that your overall allocation is well diversified. Third, don't try to pick which sector is going to win. It's tempting to say, well, the travel industry's been hit the hardest, energy stocks have been hit really hard. The reality is people typically ladder into what is safest. So high dividend paying, large cap companies. That doesn't mean that the small caps won't do better or energy stocks won't do better, but you should have a diversified enough portfolio that you're not trying to pick, unless you're a professional trader. And a lot of us have a lot more time on our hands, but that's still not a good use of our time. And so what I would suggest to everyone is make sure that you have exposure internationally, make sure that you have liquidity. And that's the one thing I'll suggest to people. These crises, when they occur, a premium is placed on liquidity. And so one of the things we say to people is make sure that you are also diversified in cash availability. Because again, what you want to make sure is that as long as you have the next year or two covered, you'll be able to ride out something like this. And so again, don't build up cash unnecessarily, but have enough that you're not going to do anything silly because your emotions are just overwhelming you and need to act.
Just very quickly, when you look at some of the businesses that have done so well in profits because there's no shortage in demand, and I think about some of the energy companies out there where they have relied on things like the airlines to be able to see broad amounts of their goods purchased so that the airlines can operate, and Carnival and all of the different cruise lines can operate. Well, when you see a hit on something like travel, or when you see a hit on something like the amount of people that need to be in an office space, how does that impact some of those other utility companies? Will we run into some demand issues for some of those other companies that are out there, and how do you evaluate that?
Well, it really remains to be seen how much we're going to change as a society. If you do not have a structural fundamental change, now I do think that I've been calling this the Great Reset. I think that we're simplifying our lives, remembering what really matters. And some of this is really positive. The reality is, as long as you don't try to make any bets, the US corporations are the most facile and adaptable to what's happening in the world. And you can have faith that we're going to continue to consume. The one good news is, as long as we make money, Americans are very good at spending it. And US companies are very good at identifying how to adapt to whatever shifts occur. And they're always winners and they're always losers. It's very hard to pick them all, which is why, again, you want to just be aware of the fact that things might change. We might go to less crowded movie theaters. We might choose to fly less. But I also believe that we're an incredibly adaptable country and people will adapt to that. So again, I think you're going to find, I think it's unlikely that we will a year from now be wearing face masks. It's possible, but if that's true, somebody's making those face masks and somebody is selling them to you. And so all along the food chain, we consume, we might consume different ways. And it's not that different than when we all started watching movies on demand. We thought a bunch of movie companies might be different, but guess what? New businesses come in. And that's true of all of our lives. You need to adapt and do nothing rash.
Joe, we got to leave things there on the day. Joe Duran, who is the head of Goldman Sachs Personal Financial Management. Thanks for taking the time here on the day.
You bet.